It takes 20 years to build a reputation and 5 minutes to ruin it. If you think about that, you'll do things differently. Buffett emphasizes the importance of reputation and integrity in business. He advises companies to prioritize building a strong reputation through ethical practices, but warns that it can easily be destroyed by a single act of misconduct or negligence. In 2008, during the global financial crisis, many large financial institutions suffered reputational damage due to their involvement in risky and unethical practices. Buffett's own company, Berkshire Hathaway, on the other hand, maintained a solid reputation by sticking to its principles and avoiding excessive risk-taking. In the business world, the rearview mirror is always clearer than the windshield. Buffett encourages managers to learn from the past but also emphasizes the importance of forward-thinking and anticipating future trends. He highlights the limitations of relying solely on historical data or current conditions when making strategic decisions. In the early 2000s, Buffett recognized the potential of the internet and technology sector, investing in companies like Amazon and Apple, which have since become major successes. His ability to look beyond the present and identify long-term trends played a significant role in his investment decisions. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett stresses the importance of investing in high-quality companies with strong competitive advantages and long-term growth potential. He advises against solely focusing on buying cheap stocks without considering the underlying business fundamentals. Buffett's investment in Coca-Cola is a classic example of his approach. Despite paying a fair price for the company, he recognized the strength of its brand, wide market reach, and enduring business model. Over time, this investment has generated substantial returns for Berkshire Hathaway. When a management with a reputation for brilliance tackles a business with a reputation for bad economics, it is the reputation of the business that remains intact. Buffett highlights the significance of considering the industry and competitive dynamics when assessing a company's potential for success. Even exceptional management may struggle to overcome inherent challenges within a particular business. In the early 2000s, Buffett avoided investing in the airline industry, despite some airlines having renowned management teams. He believed the industry's economics, characterized by intense competition and high operating costs, were unfavorable for long-term profitability. His decision proved wise, as the industry faced numerous bankruptcies and struggles in subsequent years. Risk comes from not knowing what you're doing. Buffett emphasizes the importance of understanding the businesses and industries you invest in. He cautions against making decisions based on incomplete information or acting on trends without a solid understanding of the underlying factors. Buffett's preference for investing in industries he understands well, such as insurance and consumer goods, has allowed him to make informed decisions and minimize risk. His in-depth knowledge of these sectors enables him to assess risks more accurately and identify attractive investment opportunities. It's better to hang out with people better than you. Pick out associates whose behavior is better than yours, and you'll drift in that direction. Buffett highlights the significance of surrounding oneself with individuals who possess admirable qualities and skills. He believes that being influenced by those who exhibit superior behavior and judgment can lead to personal and professional growth. Throughout his career, Buffett has sought out business partners and executives who possess exceptional integrity, talent, and a long-term mindset. This approach has allowed him to learn from their experiences and contribute to the success of his own ventures. Price is what you pay. Value is what you get. Buffett stresses the importance of distinguishing between the price of an investment and its intrinsic value. He advises investors to focus on the underlying value of a business rather than solely considering its market price. Buffett's investment in the furniture retailer Nebraska Furniture Mart is a testament to this philosophy. He recognized the true value of the business, its loyal customer base, and its competitive advantages, which led him to acquire the company at a fair price. Risk can be greatly reduced by concentrating on only a few holdings. Buffett advocates for a concentrated investment approach, focusing on a limited number of high-quality businesses rather than spreading investments too thin. He believes that careful selection and in-depth analysis of a few investments can mitigate risk. Berkshire Hathaway's portfolio is known for having a concentrated number of investments, with companies like Coca-Cola, American Express, and Wells Fargo representing a significant portion of their holdings. This concentrated approach has allowed Buffett to actively monitor and make informed decisions about each investment. Five, our favorite holding period is forever. Buffett encourages long-term investing and believes in holding on to well-performing businesses for extended periods. He advises against frequent buying and selling, as it can lead to increased costs and reduced returns. Berkshire Hathaway's ownership of Coca-Cola since the late 1980s exemplifies Buffett's long-term mindset. Despite market fluctuations, he maintained confidence in the company's enduring brand, market dominance, and ability to generate consistent returns over time. Thanks for watching. Please subscribe this channel.